the increase in underlying supplies. The the place where this market maybe resembles a different bull market in commodities has to do with the market that we experienced 2000 to 2010. I think it's going to be a mess, Lynette. I mean, a mess. I don't know how we deal with it because, again, I don't own a TV. I can just give you the arithmetic of the problem. In this country, which I still maintain is the most dynamic culture on the planet, but in this country, hold on, let me kill this, that the possibility of a 2008 style liquidity event, which is very different than necessarily the outcome of inflation, but a very fast-moving liquidity event, is a risk that's really understated because I don't think it's in people's minds. When I look at the way people act, if you give me the use of the word similar, then
Well,
yes.
okay.
It
Similar
reminds
chaos.
me the most of the 1970s
Yes.
in the sense that we're coming off 20 or 30 years of fairly benign economic climate. I'm not suggesting, by the way, that World War II was benign, but the post-World War II period from 1945 to 1970 was really fairly benign. US dollar hegemony, declining interest rates, strong economic growth. And underlying that was an investment focus on industries that were non-extractive. The growth of the United States is an example.
Mhm.
So the Nifty 50 is an example in the 60s attracted a lot of investment attention. There was not a lot of investment attention paid to underlying materials. Well, the use of those underlying materials was growing. There was a coiled spring aspect to it. At the same time, the economic climate in the late 40s and the 50s, in fact, most of the 60s, was so benign that people forgot to be afraid. They forgot to understand what was happening to the federal budget, what was happening to tax rates, what was happening to underlying wage and cost explosion. And that all came to a head in 1970. I think that's very similar to the circumstance that we face today, Lynette. If you look back at the period 1982 to 2022, I suspect that when history is written, that will be the most benign investing epoch in human history.
For decades, capital flowed toward technology, finance, and consumer growth, while raw materials were largely ignored. Yet industrial society runs on copper, energy, metals, and agricultural inputs. In the 1970s, neglecting supply while demand expanded created explosive inflation. A similar dynamic emerged during China's industrial rise after 2000, when rapid urbanization transformed global commodity markets. Hundreds of millions entered the middle class, intensifying competition for resources. Today, nearly 1 billion people still lack reliable electricity. If global development continues, demand for energy and infrastructure metals could surge, pressuring prices higher while supply struggles to catch up.
I'm less capable of commenting on the sort of zeitgeist, the sociology.
Ah,
I don't know how to dress myself. I don't own a TV. So in terms of all that, I'll rely on you to fill in the blanks of my testimony.
mhm.
I can just say that we underinvested in productive capacity at the same time that demand increased, and we ignored the increase in underlying supplies. The place where this market maybe resembles a different bull market in commodities has to do with the market that we experienced 2000 to 2010. And there, I think the wild card really was the urbanization of China,
Hmm.
the realization of Deng Xiaoping's statement to become rich is glorious. I say we because it's a triumph for humankind. We incorporated 500 million impoverished rural Chinese into middle class existence.
Mhm.
And we generated a tremendous demand for resources, competition from a people who hadn't competed with us before because they were too poor. Uh, we have done, I think, as a species, a tremendous job in the last 40 years of raising the poorest of the poor from being desperately poor to being merely poor. Uh, and it's my belief that we finish the job in the next 20 or 25 years. There are 1 billion people on Earth who have no access to primary electricity. And I think they're going to get it in the next 20 years. That's going to generate tremendous demand for energy of all sources, but tremendous demand too for things like copper and all of the things that go into enabling people to enjoy the life that you and I live. So I think the 10 years that are in front of us incorporates the circumstance that confronted us in the 70s, persistently high inflation, but also increasing demand for commodities in the face of declining supplies of commodities. And that gets exacerbated by the introduction of 1 billion extraordinarily poor consumers coming into the market and becoming increasingly wealthier. A pretty interesting circumstance, one fraught with risk, of course. Inflation is a bad circumstance in anybody's mind. And the people in the West who aren't prepared to deal with 1 billion new competitors for the stuff of life will not like the diminution in their living standards that comes from having to compete with 1 billion people. But making 1 billion people less poor is a good thing.
The modern financial challenge lies not only in inflation, but in debt mathematics. U.S. federal debt now exceeds $30 trillion, while unfunded entitlement obligations push total long-term commitments far higher. Historically, governments confronted such burdens in one of 3 ways: default, austerity, or inflation. Outright default is politically explosive. Austerity is unpopular. Inflation, however, is subtle. During the 1970s, the U.S. dollar lost roughly 75% of its purchasing power. In that same decade, gold prices soared following the collapse of the Bretton Woods system under Richard Nixon. Monetary transitions rarely unfold smoothly.
I think it's going to be a mess, Lynette. I mean, a mess. I don't know how we deal with it because, again, I don't own a TV. I can just give you the arithmetic of the problem. In this country, which I still maintain is the most dynamic culture on the planet, but in this country, hold on, let me kill this. In this country, the numbers around our money are staggeringly bad.
Yes.
The on-balance sheet liabilities of the U.S. government are at 38, almost $39 trillion. When people hear a trillion, their eyes glaze over. But it's a real number. Much more challenging to me is, and I'd be interested in your listeners' response, the off-balance sheet liabilities. According to the Congressional Budget Office, the net present value of unfunded entitlement promises, net present value, not the nominal value, exceeds $120 trillion. Now you add those two numbers together, 39 trillion and 120 trillion, you get a fairly ugly number, 159 trillion. That number is relevant when you put it in the context of the Internal Revenue Service estimate of the private net worth of all Americans combined, which is $167 trillion. We're worth 167, and we owe 159 at the federal level alone. It gets worse, of course. The off-balance sheet liabilities of the U.S. government are estimated by the Congressional Budget Office to be increasing at between $2 and $3 trillion a year. And the on-balance sheet liabilities are increasing by about $2 trillion a year. I mean, something's got to give. The math don't math.
No.
Now, what we could do is we could do what the Argentines used to do. We could have an honest default. We could say to the bondholders, too bad, so sad, no money, strong letter to follow. And we could say to old folks like you and me, yeah, we know you paid into Social Security for 60 years, but there's no dough left, so you aren't getting any. That would be the honest thing to do, but that's not the American way.
True.
What I think we do is we honor the nominal value of our obligations, and we inflate away the net present value of our obligations.
Yep.
Which is what we did in the 70s. We didn't index taxation to an accurate measure of inflation. Yeah, you got it. In the decade of the 70s, Lynette, and you've probably already discussed this with your listeners, in the decade of the 70s, according to the Office of Management and Budget, not some cranky old libertarian, the US dollar lost 75% of its purchasing power. We did this before. Not coincidentally, the gold price went up, 26, 27-fold?
Mm-hmm.
This isn't to suggest that the gold price goes up 26-fold from here, by the way. But I would suggest to you that it will take a 75% devaluation in the purchasing power of the dollar to make our nominal obligation serviceable. You'll get through it fine. You add value. I'll get through it fine. I add value. A pensioner on a fixed income who is spending $4,000 a month today needs to know that he or she will need to make $16,000 a month 10 years from now to sustain the same standard of living that $4,000 sustains today. And that's a truly ugly number.
Beyond debt lies a more opaque risk: derivatives. These financial contracts, designed to hedge or speculate on price movements, represent notional values in the tens of trillions globally. Major institutions such as JP Morgan Chase and Goldman Sachs operate vast derivatives books. While often hedged, their complexity introduces counterparty risk. What happens if one side cannot pay? The 2008 crisis demonstrated how quickly liquidity can vanish when confidence collapses. Even seasoned financial professionals admit the system's full interconnections are difficult to quantify. Complexity, while profitable in calm periods, can amplify stress when volatility strikes.
If they came and said, we are only going to let your IRA invest in government securities, I think they would become acquainted with the fact that there were 400 million guns in private circulation in the US. If they came to steal your gold again, I think there would be real political costs. If, however, they persist with deficit spending, if they persist with inflation, if they persist with artificially low interest rates, which subsidize spenders at the expense of savers, there are more spenders than savers in society, and they get rewarded for that same material. They get rewarded for those policies of wholesale theft, and they get punished for retail theft. If you assume that people seek rewards and they minimize risk, then Congress people, understanding that they're extremely popular and they get reelected, if they inflate, if they spend, if they steal from one small set of constituents called savers to benefit a very large constituent called spenders, they do well. And it seems to me that the course of least resistance, until it doesn't work anymore, is the status quo. Now, you mentioned earlier in the discussion a wild card, which is derivatives. You may know I've been in the banking business on and off for 45 years of my life, and I built a reasonably large brokerage firm. And I tried really hard to understand the risks presented to myself, my organization, my customers from derivatives. And I came to the unflattering conclusion after 40 years of study that I couldn't understand derivatives. My avocation, proof that I'm a boring boy, is that I try to analyze the balance sheets of very complex financial institutions, JP Morgan Chase, Goldman Sachs. While other people watch the Super Bowl, that's what I do. And I can't understand those balance sheets. And I'm good at balance sheets. I had a discussion with the then treasurer of Goldman Sachs some years ago. And I said, explain to me how the equity slice that you have in Goldman Sachs can intermediate a $60 trillion derivative liability. And he said, well, you're talking about the notional liability. that liability is hedged one against the other, in effect, 30 long, 30 short. We're the guarantor on both sides. I said, yeah, what about if somebody doesn't pay? You know, I mean,
That's called counterparty risk.
yeah, I mean, what level of capital is required to balance or intermediate, guarantee what level of derivative liability? The upshot of that is when I was looking for a clearing firm for my broker dealer, I looked at 13 clearing firms, no, 16 clearing firms, doesn't matter, some large number of clearing firms. And in the end, uh, rather than focusing merely on the level of services or the price for those services, I settled on balance sheet stability. I went for a clearing firm that had the lowest of liability relative to their capital base. And I would suspect, Lynette, that not one of 1,000 of your listeners reviews their banking or brokerage relationships the same way.
Mm-hmm.
That leads me to think that the possibility of a 2008 style liquidity event, which is very different than necessarily the outcome of inflation, but a very fast-moving liquidity event, is a risk that's really understated, because I don't think it's in people's minds. When I look at the way people act, when I look at the way people open brokerage accounts or insure themselves or bank without any reflection on the underlying derivative liability, it tells me that the possibility of a scare associated with that is very, very high. I'm not an economist, so I can't quantify it, but I do study the way people invest. And the way people invest does not pay as much attention as it should to the stability of the organizations that investors trust their money with.
The collapse of Lehman Brothers and the crisis surrounding Bear Stearns revealed how leverage and mortgage derivatives destabilized global finance. What began as subprime mortgage weakness cascaded into systemic panic. Liquidity disappeared almost overnight. Today, banks hold stronger capital ratios than before 2008, yet new vulnerabilities may exist elsewhere. The financial system evolves, but risk never disappears. It migrates. Complacency often grows during long expansions, leaving investors exposed when credit conditions tighten. The lesson: crises rarely originate where most people expect them.
I think 2008, we saw the product of it.
Mm-hmm.
And I will say, I was in my own way guilty, not of creating this product, but not seeing it. I remember very well to this day, driving north on the 405 freeway in Los Angeles toward LAX. And on the east side of the freeway, the right side as you drive north, I saw a great big billboard. It said, borrow 125% of the value of your home, bad credit, okay. I was not a real estate lender, but I remember thinking, because I am a lender, I wonder how this works out for them. Well, ironically, that billboard was paid for by Ditech, which was the mortgage subsidiary of General Motors, which went broke. But the idea that I, who's lived in financial services my whole life, take that in late 2006 as an indicator and reorganize my own portfolio more substantially is, I think, a reflection of just how guilty our society is at taking responsibility for their own future. If you look at the consolidated balance sheets of the equity component of the balance sheets of the big financial services firms in the US, relative to their aggregate notional derivative liability, I'm not saying it's going to blow up. What I am saying is that nobody knows if it's going to blow up. It's an unquantifiable risk that people aren't paying attention to. I am now. I have personally, since the year 2000, maintained liquidity in US dollars, but I've saved in gold. it turns out accidentally that was a good idea. That isn't why I did it. I did it because if there was a blow up, I'd prefer not to play,
Exactly.
One emerging concern involves high-yield bond exchange-traded funds. These vehicles offer daily liquidity to investors, but often hold illiquid junk debt. If investors rush to exit during stress, fund managers must sell assets that may have few buyers, triggering sharp price declines. It resembles a digital age bank run. Meanwhile, many savers chase yield without fully understanding credit risk. The broader takeaway is personal responsibility. In uncertain monetary transitions, diversification, liquidity awareness, and tangible asset exposure matter. Whether inflation, credit contraction, or financial restructuring lies ahead, preparation, not prediction, remains the most rational strategy.
I mean, the honest answer is, Lynette, I don't know, and I don't want to find out. I sort of think that the complacency in our society at every level is dangerous.
Yes.
There are a lot of things now that are better than 2008. The bank balance sheets, although they're stretched by derivatives,
Are they?
if you exit derivatives, the bank balance sheets are much better than they were. Primary capital at JP Morgan Chase is in double digits, despite the FDIC saying that a 7%, a 7% equity slice is sufficient capitalization. American banking has discovered that a higher number is probably better. I'll tell you what really scares me, and I don't want to make this whole interview doom and gloom because I think there's lots of bright things out there.
I do too,
The,
but let's talk about the doom and gloom for a minute.
the thing that scares me the most of anything are the high yield ETFs,
Mm-hmm.
ma and pa investors that are scrambling for yield in credits that they don't understand. These high yield ETFs have literally trillions of dollars in them, and they're extremely liquid. I mean, extremely liquid.
Moment.
The problem is that what they own is extremely illiquid. And if we came to a point in time where the ma and pa owners of these things began to express concern about credit and sell them, the managers of these funds, in order to fund these extremely liquid redemptions, have to sell extremely illiquid junk bonds. That's a run on the bank. Well, we had a saying when I was a young broker. I did a lot of high yield stuff in the old days, back when high yield was cheap. And we called an illiquid bond an owl bond. What that meant, Lynette, was when you called your broker to say sell, he or she would say, to who? To who?
I love that. I'm going to use that, Rick.
Please do. And the thing that really scares me aside from derivatives, I mean, the thing that scares me as being the pin that could pop the balloon is this proliferation of what should be private credit in public ETFs among people who own it simply for the yield without any understanding whatsoever of the credit risks that they're running.